AI is coming after the bankers and banking jobs. JPMorgan this year spent $20 billion on AI, by the way. Do we really need for people to go to Ivy League universities, top universities, and learn banking jobs? Only 5% of wallet holders basically use their crypto cards to make payment. Walmart in March 2026, they pulled the plug on a partnership with OpenAI. Customers were not buying. Maybe they were going to the website.
US President instructs Federal Reserve to consider allowing fintech companies to have direct access to limited payment master accounts.
And OpenAI came out and said that we have nothing to do with this stuff.
Mercury has secured 200 million fundraise with 5.2 billion valuation. They are aiming to use these funds to obtain the federal OCC bank charter. That's an interesting dynamic. I would really want to see how this battle will evolve.
All right, guys, we are on the ground. And this is the third episode, guys. And it seems like this week, AI is coming after the bankers and banking jobs. JPMorgan CEO Jamie Dimon said that AI will impact every job. And they are planning to hire more AI people and less bankers in the future. I don't know what that even means. It means like everyone needs to go and learn coding, use AI in their everyday job. He agreed that during the interview, AI efficiency will basically lead to downsizing, but said that similar patterns have been happening throughout his life because he's been at JP Morgan for a while now. Diamond said that JP Morgan sees about 10% attrition each year, equivalent to around 30,000 people, and the bank is prepared to reskill them, give them new jobs, and potential offer early retirement. During the company's investor day in February, he said that they already have huge redeployment plans, whatever that means. Otabek, AI is doing more and more jobs every day. And I wonder, with these types of movements, with these types of claims from one of the top senior leaders in banking world, do we really need for people to go to Ivy League universities, top universities, and learn banking jobs? Because again, if now everyone is looking for people who can use AI, but not, necessarily know how to do the banking, do we really need junior, bankers who usually do, prepare presentations, do research and these types of things, but they still have to pay huge amounts of money to study at the university, get a degree, and then apply for, top banks in the world. This is a very interesting moment, in my opinion.
Sam, there are two aspects of your question. One, do we still need university education? And two, are the junior roles disappearing? I think those are two separate questions. Historically, banks and other financial players would use the junior roles for two purposes.
Right.
One is to, obviously, as a more cheaper labor to do mechanical technical work. But on the other hand, the junior roles were used as a training ground for mid to senior roles. So
yeah,
if AI will take over or eradicate junior position, how they will keep the pipeline of people coming to the mid-level or senior level jobs, that's another interesting question to observe. University historically obviously has changed its role. People are not going to university. People are less going to university to get technical knowledge, but they're using it as a social, as a networking ground. So the question of relevance of university is a separate topic, and I think they need to do a lot of catching up with current situation. But I would question the decisions of the banks like JP Morgan of completely replacing junior roles with AIs might backfire in the future when they need to train mid to senior level executives.
Otabek, if I may, this is a very interesting point that you raised, because again, yes, we learn when we work as a junior, then we basically grow in our position. But look, you can learn through the AI as well, right? Because again, JP Morgan is not saying basically we want to get rid of people. They are saying like we want people to learn more AI, to learn more of coding and how to use AI. And basically, perhaps you can learn those skills that you just mentioned that would be necessarily to get senior roles through the AI by automating most of the job. No? don't you think?
I would question that, because the more you progress in those institutions, the more non-technical, more soft skills you would need, which require human interaction. And in my opinion, it's still quite difficult to learn via AI or similar tools. So the human interaction is important. The way how you talk to your clients is important. The way how you convince them to use your bank to other competitor banks is important. And I think AI is yet to come to that level where people can just learn it through interaction with the technology.
I think these skills are important when you speak to real people in front of you face to face, but it seems like more and more as we progress in the world of AI to AI communication is evolving, because I write in your emails, I'm not sure, but people are now using AI to write emails and reply to emails. Basically, there is no human in this communication channel anymore. So the really interesting development. Usually, JP Morgan sets the trend. If they say we are doing this, we are hiring more AI people, less bankers, then most probably the other top banks will follow these steps. I mean, already Citi and few other banks, top banks, if I remember correctly, if that was Citi or Bank of America, they also announced that they are doing headcount reductions because of AI efficiency and paying more attention to the AI. And JP Morgan this year spent $20 billion on AI, by the way.
Well, it's all about the bottom line, how much profit you can squeeze out by reducing your costs. And JP Morgan sees the cost reduction on the human side of the things. But in the future, if all of the banks will follow the trade and all of them will be using LLMs, what differentiation will there be between the banks? And I think what makes one bank different to another is the way the people, the culture, and the interaction of them with their customer, what defines the difference. So I think it will remain. Obviously, AI and LLMs will have huge impact on how they hire, how they structure the workforce, but I don't think the junior roles will disappear. They will remain as the training grounds. The technical skills required for the junior roles will obviously change, and people need to adapt to it, but completely eradicating it and expecting massive cost savings from that is, I think we still need to see how the technology evolves with that. Speaking of the profits and bottom lines, Sam, another news is coming from Monzo. They have announced a profit surge of 87.3 million British pounds, which is a 44% increase from the previous year. And the revenue has increased to 1.7 billion as well. That was driven by more traditional banking products, interest-bearing products, and from the subscriptions as well. The products like pocket money cards has contributed a lot for the profit. And Monzo has becoming, as we said, as many other fintechs, are the bank that they were trying to disrupt themselves. So they are taking the share of the interest-bearing products from the traditional banks, and they're sitting more comfortably, enjoying more profit, doing so via the technological advancements, helping to drive that profit and, as you said, cut the costs as well.
Look, Otarik, I would like to add a few more numbers regarding subscriptions. Monzo said some 1.6 million customers are paid subscribers at Monzo. Basically, they're paying like a subscription every month, and group fee and commissions income increased by this subscription 39% to 459 million pounds. And currently, Monzo has 15.2 million customers. However, I'm expecting intensified competition from Revolut. As you know, they recently obtained their full banking license in the UK, which is again their biggest market, and they will now actively start investing in full banking products, including saving accounts, lending. So basically, I see Revolut as one of the biggest competitors of Monzo, not more traditional banks. So they should be prepared to basically get attacked by Revolut. And when it comes to, tell me.
Another thing to mention when we are talking about Monzo and their results, obviously more challenges will appear when they start expanding outside of their core market. The US market, as we've discussed previously, is quite a challenging market to crack. compared to UK market, which is more homogeneous. The customer loyalty is there. How the customers in the US market or in the market in the other parts of the globe where Revolut is successfully dominating will be a real test for Monzo to continue showing this kind of optimistic results.
And do you know that Monzo launched in Europe, Ireland very recently? So they are expanding beyond the UK. And
they got the banking license from Spain as well, so they are expanding, which is good. But
the Spain
as we said, the US market is the challenge that they yet to crack.
No, I think they pulled out of the US market, or they didn't. I think this news has to be checked by us. But if I'm not mistaken, if I remember correctly, they pulled out of the US. They tried basically twice to crack the US market, but in my opinion, they were not able to do that. That's why they pulled out of the US market fully and now focusing mostly on the
which exactly proves my point. Them pulling out from US doesn't mean that US market is a big opportunity. I'm sure we will read the news where they will attempt to enter the US market in future as well, but it remains as the biggest challenge to the date.
Right. Otomen, and I just mentioned the biggest rival, Revolut. So they are again in the news this week. They launched their first physical cryptocurrency debit card with LED features on it, and it's available in the UK and Europe basically. And the move comes actually after a growing wave of crypto card adoption. Everyone seems to be launching their crypto cards. Crypto.com, Coinbase, Binance, they're also moving in this direction. Gemini did the same in the US. But for me, the interesting part is how popular are those cards when it comes to customer usage? I mean, what's the main difference between crypto card and the regular fiat card? Because if you know, I mean, when you are paying with a card, regardless if they position it as a crypto card or some other types of cards, you are still paying in fiat currency. You are not actually paying in crypto. Basically, what's happening is that a platform is exchanging it to fiat and enabling you to spend that.
Have you seen the card, the actual card itself?
Well, I saw the designs. It said like when you use tap to pay features, the LED will go on light flashlight. So
they got a Dodge, the picture of Dodge with the glasses which lights up. Obviously, they are tapping into the meme side of the crypto users. They are hoping for the hype. They are hoping that this will bring more attention to Revolut as the crypto player. To your question, obviously Revolut is not the first one linking crypto to the card and providing wider access to crypto liquidity. Obviously, it reduces the friction. The normal usage is you need to convert your crypto to fiat and then use your MasterCard or Visa card, which is linked to your fiat card. Here, that exchange will be automatic when you pay straight from the crypto card that is linked to your crypto account.
Yeah,
Revolut is saying it's fee-free, but there will be obviously the exchange cost associated with converting crypto to fiat. So it's not about cost saving or some sort of innovation. It's just shedding out one extra step from the user experience.
They want to capture the spread, basically. When a user spends using crypto card at grocery store, for example, Revolut is instantly liquidating that asset like crypto in their internal order book. Or gets that exchange spread. They get the spread from that exchange, and basically they avoid paying third-party wallet gateway and the fees and collect the merchant like the Visa and MasterCard interchange fees all at once. That's one of the main reasons why they're launching this crypto card. But the numbers show that retail crypto card spending remains very low. Only 5% of wallet holders basically use their crypto cards to make a payment. And as you said, this may be one of the reasons, again, first of all, to capture the economics, the spread, the interchange fees and others, and also be in the trend while you're launching. Revolut has their product strategy is like they launch a number of products at once and see which ones will work well. If that works well over the period of time, they keep it. If not, they basically kill it. This is their strategy, according to their CEO, Nick Stronsky. So let's see how this will evolve. Very interesting. Otabek, what's the next news?
The next news comes from Klarna, and it's an AI news again. I think it is disruptive to many players at the moment, financial and non-financial. So Klarna has launched ChatGPT shopping app with live prices. So basically within the ChatGPT, Klarna has a shopping search app which utilizes the Model Context Protocol, the MCP service, to feed the real-time pricing and availability. Basically, you can search for the product on your ChatGPT interface instead of going to Google search, finding a product, and then going to the merchant website. You can do all that within ChatGPT and paying with the Klarna. This shows that Klarna is trying to move up the funnel. They don't want to be just at the checkout stage of the purchasing experience. They want to be on the search phase as well, which is quite a game changer if they will be able to execute it properly.
Otabek, I think the practice of using AI for search is yes working well. Traffic from AI chatbots to research products has baseline conversion rate of 2.8 to 3%. But if you ask people to basically search and then add to the cart and make payment right in the chat, then I mean the conversion rates basically collapse. That's why I think this move, I can correct you with this move, Klarna, what's Klarna is doing, like they're saying, okay, use ChatGPT to make the search, but if you find something, then go to the website of this merchant and then finish the checkout process all over their website. And again, the practice shows already that conversion on merchant's website, on merchant's application is higher again than converting the customers inside the chat itself. As we know, Walmart in March 2026, they pulled the plug on a partnership with OpenAI where they had native checkout button directly in the chat and it was not working at all. Customers were not buying. Maybe they were going to the website to do the final etaps of the shopping, but they didn't purchase the thing on ChatGPT. And another problem was that on ChatGPT, if you add 5 products to your cart, you are basically creating 5 orders. You are not creating one order in one cart and they will not arrive all at once. They will arrive in 5 different delivery times with 5 different couriers, basically. This was one of the main problems of using basically ChatGPT or AI to make the purchases and payments directly in the chat.
I agree that the user habits need to take time to change, and obviously technological challenges need some time to change as well. But we see the speed of the technology changing, and that is quite quickly impacting the user behavior as well. However, we are talking about the discovery phase, and I think the company that needs to be worried about this is Google.
Right.
Because if you look at the traditional shopping experience, people would go and search the products on the Google. Google would first show the advertised products, and then the products that Google's algorithm thinks that will fit users' inquiry. If that phase will switch from Google search to ChatGPT, it means a lot of advertising losses to the Google itself. And I think they need to be very, very proactive on how they're going to challenge that.
And they are proactive, Otabek, because again, last week was Google I/O, and Google introduced their universal cart. It's an agentic hub for managing shopping in one place. That's basically this is how they're positioning their new solution. With universal cart, users can add products they're considering from anywhere on Google while browsing on search, chatting with Gemini, their alternative of ChatGPT, watching YouTube, or reading Gmail. And once the item added, Universal Cart tracks the deals, monitors the price drops, surfaces price history insights, and basically alerts users when items are back in stock if they were not previously. The cart also uses AI to help shoppers make better decisions according to news. For example, if you are building your first PC, let's say, you can add parts from multiple merchants into single cart. Very interesting move. This is what I just mentioned. And Google may flag compatibility issues such as processors that doesn't work with motherboard you selected and suggest an alternatives. That's a very interesting movement. Why? Because if I am an advertiser, if I pay, then would the Google suggest my products over others? For example, such as in this case, if I'm creating my first laptop and I choose a motherboard, and then Google says, no, this motherboard is not good. Please choose this motherboard. And again, because someone already paid for the ads of that motherboard to be in the search, how would that work? Very interesting for me. Also, what Google is saying, like thanks to Google's Open Standard Universal Commerce Protocol, users can check out directly through Google with participating merchants or transfer their items to the merchant site and complete the purchase there. Okay, they're trying to avoid to insist checking out directly in the chat and giving you option to go and check out basically on merchant's website, which smart move in my opinion, because again, we already saw it doesn't work really well if you make the customer to basically check out inside the chat application.
Sam, another interesting observation that I have thought when I read this news is obviously the regulatory side of it.
Okay.
It reminds the issue with Internet Explorer and Microsoft. If you remember, the antitrust regulators, the anti-monopoly regulators said that it was not fair for Microsoft to push all users to use Internet Explorer. Google will push its own closed loop ecosystem with wallets and universal card, with the data feeding through the search, the YouTube, and all the infrastructure that Google owns. That might raise some eyebrows of the regulators, and we might see interesting challenges coming from their side as well. But as we know, Google is quite used to regulatory scrutiny. There is a chance that they can stand their grounds as well. When we talk about the regulators, I think the next few news that we have is around the regulators' activity. The first one is Donald Trump's recent mandate to the Fed on the fintech access to the master account. So the US president instructs Federal Reserve to consider allowing fintech companies to have direct access to limited payment master accounts. The incentive is obviously to break up the historic monopoly of the traditional banks, being the protector and the main gateway to the main account, and the fintech companies having to work with the traditional banks to have access. This will open up the market to competition. This will open up the market to go when the regulator has opened up for the fintech companies. And it was expected for quite a long time in the US, and it looks like with the Trump's mandate, it is becoming a reality.
Although, if I briefly explain what Fed Master Account is, it's essentially a bank account for banks. It's held directly at one of the 12 regional Federal Reserve banks, and it serves as a definitive financial passport of the US. So if you hold a master account, you aren't playing on someone else's software. Basically, you are hooked directly into the sovereign financial plumbing of the US government, which is like a huge, and as you said, until this moment, mostly regulated financial institutions such as banks were allowed to integrate into this plumbing. However, very recently, Kraken got access. It's a crypto exchange, by the way, got direct access to this network. And few other players, including Wise from Europe, they are also trying to get access to this technology, to this rails, to basically streamline everything. And one of the things why financial institutions are pushing back against this proposal is that because by nature, fintechs are, and they are usually positioning themselves as a technology companies, then finance companies or banks. And arguments are, if something happens, if something goes wrong, if we see bank runs basically through these fintechs, it could quickly drain reserves on Fed's master account, which is very risky. You may say like the same could happen with traditional banks and financial institutions, but the thing is they have frictions in place against such cases. That's why they are a bit more, I would say, protected than financial institutions that are trying to get access to this technology or the bank.
The argument that the traditional banks are more protected from the bank runs rather than technology companies, I would challenge this notion. I believe the regulator will put the adequate controls around these risks regarding if it is the fintech companies or the traditional banks that have access to the master account.
I wouldn't say they are protected, yes, but I think, and it seems like to the information that I'm reading, they have frictions, and I think I need to learn myself what those frictions are to prevent such cases when it comes like in comparison to, let's say, fintech companies that are trying to get access to this technology or the way. The next news is also coming from regulators. This time, basically, SEC proposed tokenized-stock framework to Wall Street, and basically the name of this framework is like an innovation exemption for tokenized securities, and this may basically SEC said like this could go out as early as this week, but a very interesting thing happened. It didn't go out. SEC quickly pulled the plug on this. They said they got a pushback from the market, but before that, let me explain what this framework was. According to Bloomberg Law Report, that the agency was preparing innovation exemption that could allow trading platforms to offer digital version of publicly traded securities under a lighter regulatory structure. The proposal basically means you could go and launch tokenized version of the traditional stock that you hold, and those would be traded on blockchain, which would allow the companies to move faster, to settle faster in comparison to traditional stocks, and make everything slightly easier, I would say. And some of the biggest names in the market, including Nasdaq, including New York Stock Exchange, they were already preparing blockchain-based solutions to enable companies to start trading these types of stocks in the market. But what happened is that SEC basically delayed this proposal, citing that they received pushback from the market, and critics were worried about parallel crypto markets could split trading volume from traditional exchanges, and basically that way that will harm pricing discovery and efficiency of basically stock trading. Investor protection remains as the core issue in this case. It's not technology, it's rather concerns how things would work and how they may not work. And one of the things is that once you launch tokenized stock, third-party tokens without company consent, and this may cause lack in full voting and dividend rights for stockholders. And one example I will give you should remember last year, Robinhood basically launched a tokenized version of stocks of OpenAI. And OpenAI came out and said, like, we have nothing to do with this stock. So we don't know about it. It's not our stock. So this was one of the use cases why this could potentially happen.
I'm not sure if it was investor protection or protection of the income by the market players that you've mentioned that made the pushback. Obviously, if I were New York Stock Exchange or Nasdaq, I would get worried if the trading volume is moving away from me to some alternative digitized stock platforms, which actually gives more benefits and better user experience to the ultimate traders. The traditional way, if I buy a stock through the New York Stock Exchange or through the apps like Robinhood, the actual settlement will take 2 to 3 days under the hood, versus the new framework would do it instantly. You will not have to wait until the market's open to trade. You can trade 24/7, and obviously, as a trader or investor, the alternative option is better, and there is the actual risk that the trading volume will move from the traditional stock exchange to the alternatives ones. The other concerns there is obviously the stocks do not have to be issued by the actual companies, which obviously I'm not quite sure how it works. Can anyone go and start issuing Tesla stocks or Apple stocks? That's an interesting question to see.
That's very
and
obviously
they don't come with the traditional stock options like voting rights and etc. So
exactly. And Otto, yeah, you said that, for example, traditional stock exchanges are trying to protect themselves and not allowing the liquidity move away from them. But again, they're the biggest players. In my opinion, they will get the biggest benefit because, again, they have all the resources to be the first ones to implement blockchain-based solutions. And since they already have companies trading on their platform, they can go and tell them, hey guys, now we have new framework, the regulation is good, we are good to go. Use our platform since you are already with us to start trading on the blockchain. I mean, this is the power they have already in the market. Yes, there are smaller players, including, for example, Robinhood and other exchanges that could also try to launch these types of solutions. But again, in my opinion, they would rather win with blockchain-based solutions because again, they already have players on their platform, they already have companies on their platform, and they have all the resources to implement this technology as fast as they want.
The next move, continuing the topic of regulators being active in the market, is coming from the European Central Bank. They are rejecting the proposals to expand the international use cases of euro via digital rails, choosing instead to restrict its focus on the local markets. The sovereign currency protectionism is expected from a regulator over the technological expansion, but it's a matter of, are they losing the dominance of US-based USDT as a global digital currency and European digital currency being just the local payment rail? That's an interesting question. Sam, what's your take on it?
Look, just like in the US, recently I had a conversation with CEO of Coinbase, UK CEO of Coinbase, and we had similar conversation. Obviously, the US is ahead when it comes to regulating stable coins and working with the stable coins. And as a result, the market is currently dominated by dollar-based stablecoins, USDT, USDC. 99% of the market is USDT and USDC, and you do not want your local markets to be dollarized. You will depend on dollar if you keep pushing, back on these types of proposals. And in my opinion, banks are pushing back. In this case, also banks are pushing back because again, they are scared that people move away from them, basically savings move away from traditional banks to crypto platforms that are offering stable coins because again, stable coins give yield on your savings. This is one of the main reasons actually why people go after stable coins. By protecting this, you are basically increasing your dependence on dollar-based stable coins, and eventually you are increasing your dependence on dollar in general.
I would argue if the pushback is coming from the banks rather than the actual regulator, the European Central Bank, as many central banks in other countries, are the custodians of the monetary policy of the country or the region. And they use monetary policy as the lever to control the risks that are happening with the money in the country or the region. And that, I think, is the main concern of the European Central Bank. If it will go out of their control and go completely digital, they will not be able to push the buttons and regulate some monetary policies that they are used to doing historically. So that might be another issue why they want it to be localized and not moving out of the European zone.
Otabek, by this move, do you think European banks are trying to own the euro stable coin over the technology companies or crypto companies that are trying to move forward in this direction?
It's an interesting move. Cartel of traditional banks trying to push for the stable coin is something worth commenting about. Do they have the capacity? It's a big question, but it already shows the risk that we mentioned when commenting our previous news, that they are nervous about the USDT dominance, global dominance, and they want to have their share, and they want to push the regulator, the European Central Bank, to have competing euro stable coins. And that's an interesting dynamic. I would really want to see how this battle will evolve between the banks and the regulator, European Central Bank. Will the banks be able to change the ECB's mind on localizing the European stablecoin? And another question is obviously, do the banks have the capacity of the companies like Circle or Tether to actually make a European stablecoin of the same caliber as USDT?
The capacity is one question, and the other question, in my opinion, Otabek, is technology and how fast they can move. Because again, unlike technology companies, they usually tend to move slower. Again, because of the first of all regulation, and then second is because of the internal processes that take longer. That's why it might take a bit longer than, what happened in the US, or let's say in comparison to Circle or Tether, that are moving really fast and trying to basically capture the market. They all captured the majority market share in stable coins.
Speaking of the technology companies moving fast and being agile, the last news is coming from Mercury, who has secured 200 million fundraise with 5.2 billion valuation. And they are aiming to use these funds to obtain the federal OCC bank charter. Historically, the go-to strategy of the fintechs would be to use a middleman, a banking as a service provider, slap their logos on top of it, and start offering the payment services quickly, with banking as a service providers being the kind of the link between the traditional banks and the fintech. This move of Mercury is showing that they want to skip that step. They want to get their bank charter themselves and operate as a full-scale bank rather than relying on the middleman. And it is, I think, a warning signal to the businesses that provide banking as a service solutions. And in general, I think the model is the BaaS providers, banking as a service providers, know that ultimately their customers will move on and become the banks. But for me, it's a question of how the longevity of the strategy for the banking as a service providers.
And Ottavio, the market notion for the past several years is that profitability over the growth. And I can see the pattern across the board, like almost all fintechs at scale, by the way, trying to get their bank charters, because one of the goals is they want to keep more of the revenue to themselves rather than, as you said, like sharing with middlemen. And also they want to launch more banking products, including saving and lending, where the most of the profits and revenue are. And Mercury at the moment has more than 300,000 customers, and 1/3 of those early stage startups are working with Mercury. And they say they've been profitable for the past 4 years and hit 650 million in annualized revenue in the third quarter of last year, which is very significant. And actually, Mercury is one of the few companies that is still growing and increasing its valuation in customer base after inflated COVID era valuations. And they are among Ramp and Stripes of the market, which are, increasing and growing very, very significantly. And basically, Mercury, tell me what to make.
I'm also curious how the investors will be assessing the performance of such fintechs that are moving into the banking territory, because the metrics are quite different to the SaaS or fintech companies versus the traditional banks, which focus more on return on equity and capital reserves requirements. So interesting how the investors will start assessing the fintechs that are becoming banks.
Right. And other fundraising comes weeks after Mercury disclosed it received conditional approval from the OCC, and they are expecting the final approval in 2027, and then will go full scale on more banking products. But they say they want to still keep their relationship with their partners, their middlemen that's helping them at the moment. And the guys, thank you for tuning in today. This was the last news for today, and we'll keep eye on the latest developments in the world of tech and fintech, and we'll keep you updated.
Hit that subscribe button and follow us on all other platforms as well. We will continue bringing you the news on fintech, tech, and other worlds.
See you next week.